In this video, we're going to have a look at the financials of Starbucks. And I think Starbucks is a company that requires no introduction. If you have a coffee place on the corner of your street, I think there's about a 50-50 chance that it might just be a Starbucks. They are basically everywhere, which is very much a testament to their brand expansion, but of course it also means that the future growth prospects are a bit more limited because of it. Nevertheless, Starbucks has an amazing brand, so let's have a look at their numbers here. Looking at their revenue numbers, we can see a consistent growth of about 8% every single year, starting with 15 billion in 2013, ending with 32 billion here in 2022. EBITDA tells a somewhat similar story, starting with 3.6 billion, ending at 6.1. Of course, they are a coffee shop, so their margins will not be as big as, let's say, for a tech company, but nevertheless, I do think that their margins are relatively acceptable. If we have a look at their profit margins here, 19% in 2022, which has been coming down a little bit from 2013, because of course there are still some growing pains for Starbucks. Also, I normalized the number in 2013. Actually, on their records, they recorded an EBITDA of 300 million. But this is mostly because of additional acquisitions. So I tried to normalize this to give me a proper EBITDA growth number here of 5.5% every single year. Quite strong numbers here for a coffee company. Their debt levels has been increasing by about 12.8% every single year. And I think it's important to note here that from 2018 onwards, their leases are included in their long-term debt. So you might see a big spike here. It's mostly because of their leases being included. Of course, Starbucks has many different coffee places all around the world, and many of those locations are actually leased. This lease, of course, comes with a long-term contract, and of course they have to honor the obligation to pay that contract in the future as well, and therefore it's included into their debt level from 2018 onwards. We also see that overall they have a steady level of cash here all throughout those past 10 years. Never too much, never too little, always something to make sure they can cushion any additional blow. Their market cap has been increasing by 6% every single year. Now, of course, the market cap is the total amount of shares outstanding multiplied by the share price at the end of their fiscal year, which is September 30th. Their enterprise value is the entire value of the business. So we take the market cap, to which we add the debt, and we subtract the cash. And because debt has been increasing quite a bit faster than their cash has, of course we see enterprise value also increase faster than market cap itself. Overall we see a 7.2% increase, which isn't extraordinarily great, but it's definitely a very good number here. Their EV/EBITDA ratio basically tells us how many years of EBITDA, so earnings before interest, taxes, depreciation and amortization, are required for them to buy back the entirety of their enterprise value. We can see overall it's kind of shifting back and forth between the 20 times ratio. Earlier in the decade it was around 15 times. For the past 3 years it's been more around 25 to 30 times. But of course, like all the other stocks that we look at, we see a very high number here in 2020, 2021, where the multiples were definitely inflated, and it's been coming down here in 2022. Net debt to EBITDA level, we can see a very high multiple here in 2020, where they had relatively low earnings because of additional costs that they had to make. But overall, we see them circling around the 3 times ratio. Of course, in 2018, we started to include their leases. And we see here that the moment that these leases are not included, they have a net debt to EBITDA ratio of around 1.5 times. But with the leases, it's been coming up a little bit. So, of course, we take that into consideration and know that the 3.6 times multiple that we see here is a bit inflated because of the leases being included. But nevertheless, I do think that that debt level is a little bit high and could definitely be decreased, but I don't think it's in any risk of bankruptcy whatsoever, even though it's beyond the 3 times ratio. And why do I take the 3 times ratio? Well, because any investment bank will start to charge additional interest on their loans that they give a company the moment that the 3 times ratio is exceeded. Because of course, the more debt a company has, the more risk of bankruptcy and the more risk of a loaner like a bank losing its initial capital. So therefore I always want to look at a debt level of lower than 3 times. Moving over to that cash flow here, we see a cash flow from operation which has been steadily increasing by about 4% every single year, where 2018 definitely seems to be a bit of an outlier here. Capital expenditure is the amount of cost required for a company to kind of future-proof themselves. So any additional coats of paint, any additional manufacturing of additional menu items or anything, all of that is included in the capital expenditure. Of course, the cash flow from operation already includes all the other things like employee wages or raw materials. If we take the cash flow from operations and we subtract the capital expenditure, we get that free cash flow, which we can see has been increasing here in line with that cash flow from operations of about 4% every single year. Cash flow is basically your pro rata ownership of the company. At the end of the year, all the numbers that we see here basically flow directly through to you as an equity owner. And what can we do with that money? Of course, we can issue a dividend, we can buy back stock, we can lower our debt level, or we can do additional acquisitions or expansions. Starbucks has been doing all of those things. They have been buying back debt, they have been issuing a dividend, buying back stock, and of course they've been doing acquisitions and opening additional locations. So their free cash flow is very much being utilized. I think Starbucks issues a 2% dividend, and like we can see in the next column here as well, the shares outstanding has been decreasing by 3% every single year, meaning they are buying back stock at a consistent pace, meaning that your ownership of the company is increasing simply by you owning the stock and not selling it, because Starbucks is buying back shares and basically ripping them up. The free cash flow per share is the free cash flow divided by the amount of shares, and we can see here a steady increase of 7% as opposed to 4%, because of course their shares outstanding has been decreasing, which makes the free cash flow per share grow exponentially. Price per share as seen on the stock market at the end of their fiscal year, so at the end of the 30th of September. In 2013 their share price was $35. In 2022 we see 83, with a high point of 118 here in 2021. Their share price has been increasing by 9% every single year, and of course this number does not include any dividend that they have been paying, because the moment that a dividend is paid, of course the share price will decrease with that amount as well. But even when the dividend amounts are not included in this number, we still see a share price appreciation in line with market expectations. The free cash flow yield on average is about 3.5%, where 2018 was certainly a bit of an outlier, as was 2020. Overall though, I do think we see a pretty steady trend here of around the 3.5 percentage points. So this then leads us into trying to forecast Starbucks into the future. How much growth can we expect? How much return can we expect if we buy their stock right now and hold it for a decade? Looking at the EBITDA numbers for the past 10 years, we can see an average growth of about 5.5%, which is quite an aggressive growth, and I actually expect that growth to come down here in the future as we are heading into more economic headwinds, but also because I expect their expansion plans to kind of diminish over time. At a certain point, there's only so many more places you can expand to, and therefore I expect their EBITDA growth to come down here in the future. I'm going to give them 4% for the first 5 years, and then 3% for the 5 years after that. I'm also going to give them a market multiple of 18 times, which is a bit conservative when looking at their 10-year history, but I do think that overall the trend has been around 18 times, where I think these 2, maybe even 3 years have been some outliers. This gives me an enterprise value 10 years from now of $156 billion. From which we subtract the debt, we add the cash, gives us a market cap of around 137 billion. Divide this by the amount of shares outstanding, and I'm assuming that the amount of shares outstanding here remain the same. This gives me a share price of $118.18. For the free cash flow model, I'm going to do a very similar thing. We saw here historically, because they have been buying back shares, that their free cash flow per share has been increasing by 7% every single year. Because share buybacks are not assumed in our models, I'm going to look at the free cash flow increase, which is about 4% every single year. So I'm actually going to give them this 4% here for the first 5 years, and then I'm going to decrease it to 3% for the last 5. Attached to this, a free cash flow yield of 3.5%, which is kind of in line with their historic free cash flow yield. Now it might be a little bit lower, more around 3%, at which point we see a $103 price tag. But with the 3.5%, with the more conservative estimate, I get a share price 10 years from now of $88.87. Looking at the market right now, I can buy as many shares as I want of Starbucks of $108.15. Taking both our predictions of the enterprise value model as well as the free cash flow model, it gives me an average share price 10 years from now of $103.53. Simply looking at the share price on the stock market alone, I expect Starbucks to decrease in value by about 0.4% every single year. But the moment that we include the free cash flow that we predicted here in our free cash flow model, I expect an IRR of 2.4% every single year. Overall, like I always say, the market returns on average 10% every single year. So I think compared to the overall market, I expect Starbucks to heavily underperform the market. I think Starbucks right now is quite overpriced, and I would not be interested in buying Starbucks at this price point. But let's see what happens. If the price goes up or comes down a little bit. So the moment that the price comes down to about $78, I expect an IRR of around 6.7%. At which point I am still not interested in buying this stock, but it's certainly coming a bit closer to what I deem to be acceptable. I think for me to be really interested in Starbucks, I want it to be around the $65 range, which I don't expect it to be anytime in the future. This was it for Starbucks. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!